All right, we're live. So my name's Amar, and this is
Kyle, hello.
hey. We're finally getting that rhythm down, right, Kyle?
Yeah, I didn't interrupt you this time. Or
There we go.
yeah,
And we're going to talk about why you should still be doing Roth conversions while you're in retirement. Now, I know this is a topic that comes up from time to time, but before we get started, trying to find my mouse. We got to do some disclosures, right? I think the big one here is that we haven't taken your accounts or your situation into account, and we haven't entered a client advisor or CPA type relationship. This is strictly for educational purposes. What did I miss, Kyle?
pretty much nailed it. Yeah, I'm not your CPA, and Mars not your financial advisor, not yet, at least.
Yeah,
And
there you go. All the contact information will be in the, what do they call it, the description below. So please reach out to us if you need help or if you have questions. Happy to take some time to answer them. So let's change this back to you and I, and let's answer why. I guess why should you still do Roth conversions in retirement, or you want to start with what is Roth conversions, there, Kyle?
yeah, so typically when you are socking money away into your 401k or into your, if you have a traditional IRA, those are all on a pre-tax basis, meaning that you get a tax deduction when you put it in. You get the tax deferral and the growth, and then when you take it out in your retirement years, it's taxable income. So a Roth conversion is taking money from your traditional or pre-tax accounts and turning them into a Roth account, which is a post-tax account. Now, a Roth conversion is taxable, but we'll go into the reasons why we like Roth IRAs more than a traditional. I think it's a better inheritance vehicle. If you're going to pass money on to your kids, it's better to pass them on with a Roth IRA. I think another line of thinking of ours is, I don't think tax rates are going to go down in your retirement years, which is kind of a tenet of the traditional IRA, and so
Yeah.
that might
So
not actually be the case in the future. And and there's a bunch of other rules that come with the traditional IRA that the Roth doesn't have to deal with. So
yeah, so like the Roth doesn't have a RMD requirement, right? And I think that's a big one for people that are looking for flexibility in retirement. But let's go over the top three, right? Let's kind of frame this. So like the first reason you want to do a Roth conversion is that it's going to protect you from future tax increases or potential increases. It even gives you more flexibility while you're in that later years of retirement to pull from different buckets to create most favorable tax situation for you. The second reason is really around survivorship. So if either spouse were to predecease, I guess one spouse will predecease the other spouse. Their surviving spouse gets hit with losing a standard deduction, and the tax tables for a single individual are a lot narrower and smaller than when you're married filing jointly, right? So call it the widow's trap, whatever you want to call it, but this helps the surviving spouse in terms of taxes, right? And I've known a couple of clients, that it's almost like a tax bomb for their surviving spouse. And same IRA, same assets, it just gets taxed at a lot higher rate and a lot more of it because of losing the standard deduction. And then
that's
the
right.
third, yeah, and then the third, really to frame this, is that for your children, from a legacy perspective, with IRAs, because of the Secure Act, a non-spousal beneficiary has 10 years to take distributions. And in a Roth IRA, you have the same 10-year period, but now your children can leave the money in that Roth and let it grow tax deferred, tax free, and then in the 10th year take all the money out at that time. So those are the three biggest benefits. And when you're doing these Roth conversions, there are things that you should be aware of, right? So Kyle, do you want to go over some of the things that you look at? Like, for example, you want to stay below the next tax bracket, so you want to be in the highest amount within the same tax bracket. And
Yeah, I think I've had a number of clients that, kind of approach maybe in their 60s and 70s. They have a large balance in their traditional IRA or 401k in the pre-tax account. And, they've done well throughout their life, and they're going to have excess money that they're going to either pass on to their kids or, for their spouse or whoever that may be. And so a traditional IRA is probably one of the worst inheritance vehicles there is. And that's probably the first bucket you want to pull from. Whereas a Roth IRA is probably the best inheritance vehicle there is. Because you mentioned that 10-year period, you get tax free, not tax deferral, right? So any growth in a Roth IRA is tax free because you've already paid the tax putting it in. Whereas a traditional IRA, anything that grows is going to be taxable. It's a tax deferral, not a tax free, and it's all ordinary income. And so you don't get capital gains. You don't get to offset it with any other losses. You don't, it's probably one of the worst tax vehicles for your kids to inherit is the traditional IRA. And so I've had a number of clients in their 60s and 70s kind of go, well, I don't need this traditional IRA. I'm going to have other funds to pull from in my retirement. Why don't I start, converting it to a Roth over a number of years, in my retirement while I'm still alive, and get that step up in basis, get a better inheritance vehicle for your kids, and then also kind of just play that tax bracket game year after year to kind of deplete your traditional IRA. So if you have, $400,000 in your 401k, for example, maybe pick off $50,000 a year for the next, 8 to 10 years kind of thing.
Yeah, and I think you got to really work with a tax professional like Kyle or your CPA or whatever, but you really want to line up where you are within the bracket to see how much room. Now, remember, you're going to back out like capital gains and stuff like that because that's at a different tax rate than ordinary income. And you're going to also want to figure out where your modified adjusted gross income is, because if you have Medicare Part B, that's going to influence your Part B and D premium that you pay. So those are two numbers or bogeys that I think you should be cognizant of. But you should really max out as much as you can to stay below those two dollar amounts, and then really build yourself, I would call it flexibility or control for later in life. Because none of us know what's going to happen, but I think giving yourself that flexibility is good. Anything else you want to add there, Kyle?
Yeah, maybe you could talk a little bit more about the Medicare Part B and Part D premiums and kind of what that threshold typically has been in the past. And
yeah, I have this chart. It's not on my desk right now, but it's based off IRMA, right? Like and those scales. Basically, your Part B is based off of your ability to pay, and as you have more income, your Part B premium just keeps going up, and so the tax bracket. I'm just using round numbers. Let's say it's at 175, and the Medicare Part B, let's just say, is at 160, right? Those are two different numbers. So if you're only looking at the tax brackets, you may accidentally increase your Medicare Part B premium 2 years down the road because you max out that tax bracket, but you hit the Medicare.
Yeah, I had a client in the past that just barely got over that Medicare premium level and then had to have this additional premium tax that kicks in. And like you said, it's not exactly tied with your tax bracket year after year. It's from the Social Security Department, I believe.
Yeah.
And so, that catches some people by surprise, and it's definitely something to monitor. And that sounds about right. I think it's around that $170,000 level.
Yeah,
but don't quote me on that.
Yeah, there's a whole scale there, and so that scale increases with inflation each year. So it's not like a static number. So it's just kind of like a moving target, and it influences your Part B 2 years down the road. So I think with that, I think we're good, Kyle. Do you want to do like a quick summary, or should I do a quick summary? And then we should. I think that's a good information to get to people.
Yeah. So if you have any questions about, traditional and Roth and kind of how it ties into your estate plan, or how it's going to affect you in your retirement years, or like you said, how it would affect your surviving spouse or your children, those are all great discussions to have. And everyone's situation is a little bit different. So it can be a little situational, and that's where Amar and I specialize. So we're happy to talk with anybody that has questions. And thanks again for watching.
Sounds good. Bye,
Bye,
Kyle.
Amar. Till next time.